I'm Charlotte McLeod with investingnews.com, and here today with me is Adrian Day, president of Adrian Day Asset Management. Thank you so much for being here. Great to have you.
Always good to see you, Charlotte.
Yes, nice to have you here in person. We're at the Rules Symposium, and we've made it a few days into the event. So I thought we could start just by getting your sense of the atmosphere here, any interesting conversations or takeaways you have.
Yeah, I would say, we've got to remember that these are dedicated gold investors. These are primarily people who've been in the market a while. They've been through the ups and the downs. They've made money. Okay, the last few months haven't been too good, but, we've got to remember they're people who've made money in this. And I would say that the general mood is, cautiously optimistic. The people here really want to learn more about individual companies. There's no question about that. People don't like the fact that the market's come down, and they certainly don't like the fact that it's come down again this week. There seems to be a conference curse where every time you're at a gold conference, the market falls, probably because none of us are at our desks buying. But I certainly, there's no panic. There's no, it's certainly optimistic and cautiously optimistic, yeah.
Right, and I think this is going in exactly the direction I wanted to go. So we last spoke back in March. Gold was still very elevated, not to the level at the beginning of the year, but still high. And you were very reassuring. You said what we were seeing was normal. So how are you feeling now that we've had that further price pullback for gold?
Yeah, well, pullbacks in corrections in a gold bull market are normal, and obviously the classic example is 1975 when the gold price dropped 45%. But we even had a 35% drop in gold, not in stocks, in gold in the middle of the noughties. Is that what you say?
Yes.
Silly word, but anyway. So that's a normal reaction, and it's a normal thing in any bull market. Actually, it doesn't have to just be gold. So this has gone on a little longer than I thought it would, to be honest. But I did say that I didn't think, or at least I think I said, that I didn't really think we would see gold turn around and reverse until the war was clearly over. Well, this week it's clearly not over. And the big concern, of course, about the war, as we said back then, one thing is we seem to forget that there's a safe haven asset called the dollar. When you have a situation like this, the dollar moves up. Other things being equal, a higher dollar is bad for gold. Then you've had the bond market already start doing the Fed's job for them and pushing yields up. So you've got higher yields plus a higher dollar. These are tremendous headwinds for gold. And of course, the CPI moving up only adds fuel to concerns that the Fed will hike rates. So yields will go even higher, and higher rates in the US mean the dollar will go even higher, other things being equal. And so we've really got a triumvirate of headwinds here. But they all revolve around the war. So if the war ends, the dollar falls, the oil price falls, relieves pressure on the CPI, which relieves concerns about the Fed hiking, and not just the Fed, it's central banks around the world, as you know, that are concerned, that are talking about raising rates. So, that's where we are. And so the real question is, when does this start to reverse? Again, the most important thing is the war. When that ends, one way or the other, the oil price retreats, CPI expectations come down, the dollar comes down, and, that then is positive for gold. But we're not there today.
Yes, well, you have answered one of my key questions, is what sparks that turnaround for gold. I think the other one that I see people wondering right now is, okay, we can accept that we are at these lower levels for gold, but have we seen the bottom yet? So any thoughts?
Yeah, look, I'm sorry, I always do this to you, don't I? You ask a simple question, and I think it's important that investors realize, whether you're an individual investor or whether you're a money manager, making predictions is not the important thing. So with all due respect, And that's a very valid question to ask. But when people, let me flip it around. Some people say, well, what do you think the price of gold will be in December 31st? Sort of not the question to ask. But as investors, we should be looking at the risk and reward, the risk and or the reward and the risk at any given moment. You're at a starting point. So what's the risk? What's the reward? I would say that I think there is a high possibility, not a probability, but a high possibility that we go down to test that low from a month ago and we fail at that low. And if we fail at the low, gold could easily go back to 3,600 and the gold stocks would go down meaningfully more from there. If you're a long-term investor, a long-term investor with a conviction on the gold price being higher 3-5 years from now, and you're not already overweight, then don't try to pick the bottom because you'll miss it. I think this is just a great time to find some really good buys in the gold space. But would I put 100% of my cash to work right now? No, I wouldn't, because I think there's a high probability we see meaningfully lower prices at some point. Again, so much, this goes backwards and forwards, just a tweet or whatever you call them these days, a post from the president will, change things dramatically. But what I would say is, if you're a long-term investor, whether you buy, for example, Agnico at 160 or 155 or 151, in 5 years' time, won't make a huge amount of difference. So that's one thing. And the other thing I'd say, look, gold stock prices, we're down 40% from the January peak, so prices are down. Valuations have come down tremendously. We can talk about that if you want, but valuations are across the board are in the lowest quartile of the last 70 years, and for some companies on some metrics even lower. So the valuations are down, and the sentiment is just incredibly weak, with money flowing out, not flowing, gushing, like an oil well. Money's gushing out of the GDX. Nobody's interested in buying the stocks. The bull-bear sentiment index is at 7, which is 7 bullish, which is unbelievably low. So you've got prices down, low valuations, and extremely weak sentiment. For a contrarian, that's just about as bullish a setup as you could possibly find.
I think it's a great idea to reframe the question, and it's a theme that's been coming up here in my conversations, is to stop trying to time the bottom and find a price that is looking good enough. So hopefully that will resonate with people.
Right. But I do, if I had inherited $1 million today and I had no gold, I would certainly put some of it to work. Is it half of it, a third of it, 2/3? I'm not sure. I would definitely put a meaningful amount of it to work today, and I would definitely keep a meaningful part aside, for future if the market drops more.
Right. And we can talk about the company valuations, because I remember back in March you were saying that gold stocks were generally still pretty inexpensive. So I can only imagine that now they're looking even better. So how are you seeing it?
Yeah, absolutely. Well, now it's not just me saying it, but Scotiabank came out with a report last week, which a lot of people have seen and talked about. And basically they went through, I think it was the top 20 producing companies, and they looked at all the different, it was just a series of dot plots. They looked at the different valuations today and then every single year, for the last 50 years. And on every single metric you care to look at, we are in the lowest 25 percentile today. So we're in the lowest quartile, that's a better way of putting it, the lowest quartile at a time when the gold price is still very high, and at a time when the margins are still remarkably strong. If Agnico has an all-in sustaining cost under $1,340, their margins were better at $5,500, but at $4,000, they're still pretty darn good. And so yet on every single metric you care to look at, the prices this year and the forward-looking valuations for next year were in that lowest quartile. That's remarkable. And on some companies, on some metrics, look at Agnico. I just mentioned Agnico. Look at Agnico. You look at Agnico on a price to cash flow basis, they are within a hair of their all-time low price to free cash flow, which is my favorite metric for senior gold stocks. So I think when we talked last time, I said they were in the lowest 10%, right? But now they're basically at the bottom. Does that make sense?
No.
Does that make sense? It doesn't make sense at all.
So for your average person, does it make sense then to just stick with those senior gold producers versus going down the chain?
I would certainly say if you're looking at buying well, we're seeing value across the board.
Okay.
I need to say that.
Yes.
I think if you're new to the space, I would certainly most of the money I put to work would be in the really high quality seniors. Because that's where money will first flow back into, right? When the market turns and money flows in, it'll flow to the big cap stocks first. You know, that's a tricky question to answer because here we are, the rickshaw.
Of course.
And, we all love, use the word dabbling, which is not the right word, but we all love dabbling in juniors. It's more exciting and the potential's more and everything else. I think if you're an investor that's not very experienced in space, you don't have a lot of experience, but you don't have a lot of knowledge about the space, and you don't have a lot of time to devote to following it, I honestly think that if you buy half a dozen of the quality big cap stocks, the miners and the royalty companies, you will probably do as well as most people who are buying the juniors. As humans, we either remember only the good or we remember only the bad. We never seem to remember both. So you have people who will tell me, oh, I bought Diamond Fields when it was 25 cents. Oh, I made so much money when we sold it at 40. And they've forgotten all of the things they bought that went to zero. And conversely, there's some people, who only remember the bad and they forget the good. So what I would say is that I think for most people in the situation I mentioned who don't have the knowledge or experience and the time, buying juniors buying exploration companies can be very, very dangerous.
All right. I think that gives us some idea on how we could operate in this situation. Going back to gold market drivers, I want to make sure to bring up the Fed because we have our new Fed chair, Kevin Warsh, since we last spoke, and very keen to get your thoughts on his comments after the first meeting that he was at.
Well, again, simple question, but let me stand back because I think as always people have a context. The context is I don't like the Fed. Can I wave?
You can.
Okay.
You can emphasize.
I'll do that meme.
There you go.
There you go. I think the Fed as an institution is, I just don't like the Fed as an institution. They are trying to do something that is impossible. Not difficult, but impossible. You have a group of 8 people sitting around a table in Washington, D.C., most of whom are academics or have worked at the Fed or in the government their entire lives, trying to fix the price of the most important price in the economy, namely the price of money. They are doomed to failure, just as all price fixers are doomed to failure. The history of the Fed has not been strong. Since the Fed came in, the dollar, their mandate is a stable dollar, right? The stable's lost 99% of its purchasing power. So they have been an utter failure at their primary mandate. They have presided over and enabled the greatest depression in U.S. history and the greatest inflation in U.S. history, both. So I'm not a fan of the Fed. I just want to make that clear. And I wasn't a fan of Powell, and I was particularly not a fan of the two before. Yellen and Bernanke, I thought, were just absolutely awful. Having said all of that, and at the risk of sounding naive and open to changing my mind, I was very pleasantly surprised by Warsh. Warsh comes to the Fed with two things. One, with deep knowledge and experience of markets and how markets operate and how the free market, how the economy works. And also, he's obviously thought long and hard about the Fed. And that press conference, there were some very, very key points he made, even though all his answers were fairly brief, right, and to the point. But he has obviously thought about the failures of the Fed, and the things that they're doing wrong. One thing that he mentioned, for example, was the Fed's reliance on data. And he made the point that this is backward-looking data, but it's not just backward-looking data, it's old by the time the Fed gets it. And he said there are better ways that we can collect data these days. He mentioned the importance of listening to CEOs who have a up-to-the-minute finger on the pulse of part of the economy. And if you listen to 50 CEOs, you're getting a pretty broad knowledge of how the economy is operating now. Think about the unemployment report. It comes out in the middle of a month. So it's already, on average, it's 2 weeks from the last day of the month, 6 weeks from the beginning of the month. So already you're a month out of date. Then they revise that once and they revise it twice. So you really don't know what February's unemployment was until February, March, April, May, until May, middle of May. So that information is 3 months out of date by the Fed. By the time the Fed gets it, looks at it, and decides how they should react to it. There are, as he said, there are better ways of collecting data these days. So that's just an example. So anyway, no, at the risk of sounding naive, I was very impressed with him. We have to acknowledge that there are constraints. There are political constraints as well as economic constraints. You know, you can't have interest rates, you can't do what Paul Volcker did in 1980 and raise interest rate to 80% within 9 months. You can't do that today because the credit market would just blow up. You know, we have so much more debt now than we did then. So anyway, there's political constraints and there are also economic constraints.
So tentatively, maybe this time could be different, but we'll have to wait and see.
Well, we never use those words, do we? This time is different. But
I know,
it could
I shouldn't
be. You
say
said
it.
could. No, you said could.
Yep.
So yes, we can say this time could be different.
Okay, we'll see. The other thing I wanted to ask about the Fed, so we were talking again the previous time we spoke about the increasing division within the Fed.
Yeah.
Do you see that intensifying?
Yeah, no, that's an interesting question. I think so, because the Fed, for many, many decades now, has really been a very collegiate body, and they very rarely have you had dissents. Under Powell, and increasingly, we have had more dissents than we ever had before, but it has still been relatively collegiate. They've certainly never voted against the chairman, but I think that collegiality, I think that collegiate nature has been broken. Obviously, at this first meeting of Warsh, there were no dissents, and the the statement that they put out was 100% endorsed. I think that's going to change. That was, you don't go against the new chairman on his first day on the job. That's going to change. But Warsh is I would imagine that Warsh, I don't know this, but I would imagine that Warsh is a very persuasive figure, in argumentation. He knows his facts, he knows his position, he can argue. So we may well get some dissents. There's obviously a lot of a Fed that wants to raise rates and raise them sooner, but you also have one or two that are still dovish. So I think we will get dissents, but the real question, if the Fed wants to raise rates, is when do they do it?
Yes.
I think they're going to have to do it in July if they're going to do it, because I find it difficult to think that they will raise rates immediately before the midterms.
So that's this month. We're in July now, so that will happen.
I think it's on the 29th is the meeting, I think. They could do it in September, but they're not. I mean, I'd be very surprised if they do it in October, right before the midterms. However much they like to say we're non-political, we don't look at politics, of course they do.
Anything else? The midterms, that's a topic I've been trying to discuss here as well. Anything else we should be watching, potential impact there for the markets?
Oh, gosh. Well, I'm not a political analyst. I hadn't really thought about this before you asked me. I mean, clearly, if the Republicans lose either the House or the Senate, which at the moment is looking probable, then the president will be less able to get away with the executive orders and the rule by edict, which the Republicans in the House and Senate seem to just be willing to let him get away with. Now, he's not the only one, of course. I mean, we know that the last president, well, Obama, really, President Obama was the one where the number of executive actions just shot up dramatically over previous presidents. But it's been on the rise. The trend is upwards. So that's not a political comment at all. I'm not. But certainly, if you have to get stuff through Congress, and the Democrats control one of the houses, it is going to be very, very difficult because, as you know, and again, this is a political point, I'm sorry, but as you know, the current Democratic party seems to want to do anything it can to frustrate Trump. So I don't think you're going to get, and I'm trying to be an analyst on this, not a politician on this, but you know, in a normal, let's say with a normal president in a normal scenario, the opposition party might not like what's coming down, but their goal is not to frustrate every single thing that comes down. There'll be some things that they're willing to compromise on and to get through. And I think I'm not the only one that says this, I think a Democratic House or Senate will lead to gridlock because they will not want anything with Trump's name on to get done. And I don't mean the Kennedy Center. I mean any measure with his name on.
All right, sorry to put you on the spot with that one, but I think...
Sorry,
No, of course.
but a deadlocked government is actually often good for the markets.
Well, there you go.
I should mention it. Yeah.
Yes, no, that's good to know about. And again, looking a little more broadly, I wonder if we put together the elements we've been talking about, what is your outlook right now for the U.S. economy? I think at this event, I've been hearing so much about we have all these warning signs that are not amounting to anything because of the money printing element. So,
yeah, the money printing element is part of it, and the other element is, the U.S. economy has been so strong for so long. There's a huge, the infrastructure is already built. You've got a huge amount of savings, even though people aren't saving today. There's a huge amount of new money in the system, but also, older money, if you want to put it that way. Adam Smith put it well when he said there's an awful lot of ruin in the nation. Meaning, so things can take a lot longer. And we've talked about this before, but the fact that you had such a strong economy for so long, and with corporations able to roll over their debt and extend it at lower interest rates and so on and so forth, that means you can withstand the negative for a lot longer. Having said all of that, I am a bit surprised at just how resilient this economy's been, particularly how resilient the consumer's been. I definitely think there are some negatives in the economy that are, that the headlines do not reflect the reality. And we mentioned employment earlier. Employment's a good example. So last month we had that blockbuster jobs number, right? Where the new jobs creation came in twice what expectations were. And the market, the stock market went up and gold collapsed because it meant, they're going to raise interest rates. Well, now what's happened since then? Number one, the last jobs number was a big disappointment with only basically half the number of jobs. We revised downwards last month. Big surprise. So we revised downwards this blockbuster number, but here's what's really critical to me. You look at the Bureau, these are from the Bureau of Labor Statistics themselves. This is not, Adrian Day. This is the Bureau of Labor Statistics. 5.1 million people actively looking for a job who have not got a job, but in the last 4 weeks haven't visited an employment exchange and so do not count as unemployed. don't know about you, but if I were unemployed, after a little while, I would not be going down to that unemployment exchange every week because I'm sitting there for 4 hours and they're not offering me any jobs that are of any use to me, so I stopped going. They don't count as unemployment. That's 5.1 million. Then you've got 4.8 million, Bureau of Labor Statistics numbers, 4.8 million who are actively looking for a full-time job but are employed part-time. They don't count as unemployed. So now you've got 11 million people actively looking for a full-time job who don't have one, who are not included in the unemployment. Then you've got the labor participation rate. Those people are included in the labor pool. Now you've got the labor participation rate where people have just dropped out of looking. They're no longer looking for a job. Now, they might be older, they might be, retired, they might have joined the military, but they're out of the labor pool. And that labor participation rate, as you know, has dropped again to another new 20-year or whatever low. So put all those things together, and then the final thing to add to that is when you looked at that blockbuster number last month, over half of that was local government jobs. I've said before, I don't think a labor market is healthy when over half your jobs being created are government jobs. So I don't think the labor market is anywhere near as strong as people think it is. People point to the unemployment rate being low, but remember the unemployment rate was changed. If you look under the U6 number, we're significantly higher unemployment. I think right now it's about 8%, but someone will correct me. Sorry, I lost my train of thought there. So anyway, yeah, people look at then they look at the fact that the quits are low. That's not a sign of a healthy economy. If I'm employed in a job with a paycheck coming in and I voluntarily quit, I do it because I think I can find another job easily. If I don't think I can find another job, I don't quit, right? I mean, it's got to be really bad. The boss has got to be really nasty and mean for me to quit when I think I can't find another job. So the fact that the quits are so low is actually a reflection of a weak employment market, not a strong one. So we could go through all these things.
Yeah, and when you start to dig into those nuances, I think the picture does become much clearer. So Thank you for going into those. I know I need to start wrapping it up and get you out of here, but the final point I wanted to mention. So we're here at the Rural Symposium. Your presentation was, besides gold, what else? Usually we focus pretty heavily on gold. So anything you want to pull out that you think investors should also be looking at?
Yeah, I mean, typically in a commodity cycle, and commodity cycles tend to be long with big corrections midway through, but a commodity cycle tends to be long, and typically gold leads at the beginning. It's a monetary metal. It leads at the beginning because of the monetary factors, and gold tends to lead at the end, in the blow-off phase, but other commodities tend to lead in the middle, and this was certainly true in the 1970s. So copper, I think, is phenomenal just because of the projection demand and the projected supply. We clearly have a deficit starting in about 2030. That's 4 years from now. And deficits, of course, you don't have a physical deficit in a commodity market. You have higher prices. But we talk about deficits. So there's a gap between, that's a better way of putting it, or a more accurate way of putting it, there's a gap between expected demand and expected supply. Oil is another. Of course, it's difficult to trade oil unless you're a trader. It's difficult to buy oil or oil stocks and investor in this kind of environment with the war going on. But until the war started, oil is the most hated commodity out there other than coal. Nobody wants it. And so because nobody wants it, and because the oil companies are told that we're going to be fossil fuel within 15, we're going to be fossil fuel free within 15 years, what's a logical response of an oil company? Do you put billions of dollars into the ground looking for oil, or do you not? And do you just raise the dividend and buy back stock? And so we have had gross underinvestment in the oil market from about 2014 through to basically this year. Gross underinvestment. What that means is But when the demand, in a few years, as demand continues upwards, you simply won't have the supply. You won't have the supply to meet that demand because we've underinvested for so long. I also talked about global markets, something outside the resource market, because I think the global markets, or I should say foreign markets, so the non-US markets relative to the US market are at extreme lows. At the beginning of last year, they were at all-time lows. Foreign markets had never been as cheap relative to the US as they were at the beginning of last year. And I think we're going, as the AI bubble bursts, which is happening right now before our eyes. You know, before I came to this show, you could look at Microsoft, NVIDIA, Amazon. They were all down 15 to 20% in the last month, while the S&P was essentially flat. So you can see clearly rotation. It wasn't a crash in the S&P. It was rotation out of the big tech stocks. It's happening before our eyes. I think it's going to continue. And the main reason the foreigners have been invested in the U.S. so heavily for the last 5 years is because of big tech. You know, if you want exposure to big tech and to hyperscalers, if you don't want to invest in China, you have to invest in the U.S. And now that bubble is bursting, that money, I think, will start flowing into foreign markets. So the global equity, the foreign markets now, obviously there's differences. Some are more expensive than others, but global markets, I think, are definitely a place to be looking.
Well, I think that gives us a number of different places that we can look other than gold. So thank you for going through that. And I'll let us finish up here. Thank you very much. This was great to have you on.
Well, thank you very much for asking me, Charlotte. Always good.
Of course. Yes, so nice to see you. Looking forward to the next one. And for now, once again, I'm Charlotte McLeod with investingnews.com, and this is Adrian Day.